Disclaimer. Disclaimer.
Good morning, everyone. This is AG. Today, we're diving into a topic that has been quietly developing but is about to send shockwaves through the global political and economic landscape. It's a story of ice, ambition, and a potential fracture within the most powerful military alliance in history. We're talking about Greenland, Denmark, and a multi-billion-dollar defense spending plan that puts it on a direct collision course with the United States. This isn't just a regional dispute. It's a development with profound implications for NATO, global markets, and your investment portfolio. For decades, the Arctic was a frozen backwater in global affairs, but climate change is rewriting the map, opening up new shipping lanes, and more importantly, exposing a treasure trove of resources. Greenland is at the epicenter of this new great game. It's estimated to hold vast reserves of oil, natural gas, and rare earth minerals, the very elements crucial for our modern technology, from smartphones to electric vehicles and advanced defense systems. The United States Geological Survey estimates that the Arctic holds about 13% of the world's undiscovered oil and 30% of its undiscovered natural gas, with a significant portion of that located in and around Greenland. Washington has not been subtle about its interest. You might remember the headlines back in 2019 when the idea of the U.S. buying Greenland was floated. It was dismissed by many as a joke, but it was a clear signal of intent. The U.S. already operates its northernmost military base, Thule Air Base in Greenland, a critical component of its missile defense and space surveillance network. For the Pentagon, Greenland isn't just a resource hub. It's a strategic military foothold in the high north, a bulwark against growing Russian and Chinese influence in the Arctic. This brings us to Denmark. Greenland is an autonomous territory within the Kingdom of Denmark, and Copenhagen has been watching America's growing interest with increasing alarm. For years, Denmark, like many European nations, relied heavily on the use of security umbrella, allowing its own defense spending to dwindle. But the tone has shifted dramatically. In a move that has stunned many in the international community, Denmark recently announced a massive multi-billion-dollar investment in its defense capabilities, specifically focused on the Arctic. Let's break down the numbers because they tell the real story. We are talking about a defense package worth approximately $21 billion over the next decade. This includes long-range drones, advanced surveillance satellites, new frigates capable of operating in icy waters, and anti-air missile systems. The official line is that this is for Arctic surveillance and enforcing sovereignty. But let's be clear, the only nation with the capability and stated interest to challenge Danish sovereignty over Greenland in a significant way is its own NATO ally, the United States. This isn't about fending off fishing trawlers, it's about creating a credible deterrent against a superpower. Denmark is drawing a line in the ice. The geopolitical fallout is potentially catastrophic for the Western alliance. NATO is founded on the principle of collective defense, Article 5, where an attack on one is an attack on all. But what happens when two members are in a state of escalating military and political tension with each other? This isn't a hypothetical question anymore. The Denmark-US standoff over Greenland creates a deep structural fracture within NATO. It undermines the alliance's unity and credibility at a time when cohesion is more critical than ever, given the global security climate. Other NATO members are now in an impossible position. Do they side with the US, the alliance's traditional leader and military backbone, or do they support Denmark's, a smaller member state asserting its sovereign rights? This division could paralyze NATO's decision-making processes and embolden adversaries who are eager to exploit any crack in the Western Bloc. We are witnessing the potential for a diplomatic crisis that could unravel 75 years of transatlantic security architecture. Now, let's pivot to what this means for the markets, because that's where the immediate impact will be felt by investors. First, let's look at the defense sector. The obvious winners here are the major defense contractors, companies that produce naval vessels, surveillance technology, drones, and missile systems are poised to benefit not just from Denmark's spending, but from a ripple effect across Europe. As tensions in the Arctic rise, other Nordic and European nations will feel compelled to upgrade their own military hardware. We're talking about a new, sustained cycle of defense spending. Look for stocks in companies specializing in Arctic-capable equipment and advanced aerospace and surveillance technologies. This isn't a short-term bump, it's a long-term strategic shift. Second, the energy markets. The opening of the Arctic and the dispute over its resources will introduce a new level of volatility. If Greenland's resources come online, it could, in the long term, put downward pressure on oil and natural gas prices by increasing global supply. However, the short to medium term picture is one of instability. Any escalation of tensions, any military posturing in the region, could threaten new shipping lanes and exploration projects, causing price spikes. The key takeaway here is uncertainty. The Arctic is a new and volatile variable in the global energy equation, And traders will be watching every development with bated breath. Third, and perhaps most critically for many investors, is the impact on rare earth minerals and precious metals. Greenland is thought to hold one of the world's largest undeveloped deposits of rare earths. Currently, China dominates this market, controlling the processing and supply of elements vital for everything from wind turbines to F-35 fighter jets. The West has been desperately seeking to break this dependency. Greenland was seen as a potential solution, a friendly source of these strategic materials. However, a conflict between Denmark and the US throws this entire plan into jeopardy. If access to Greenland's rare earths becomes a point of contention, or if development is stalled due to geopolitical instability, it will reinforce China's market dominance and create massive supply chain risks for Western tech and defense industries. This uncertainty will inevitably drive up the price of rare earth elements and the stocks of companies that mine and process them outside of China. Furthermore, in times of significant geopolitical instability, where do investors traditionally flock? To safety. This crisis has all the hallmarks of a major flight to safety event. We're not just talking about a regional skirmish, we're talking about a foundational crack in the post-World War II global order. In this environment, assets like U.S. Treasury bonds may see some inflows, but the real beneficiary will likely be precious metals. Gold and silver are the ultimate safe havens. When trust in international alliances and even the stability of the global financial system is shaken, physical assets that have held their value for millennia become incredibly attractive. The tension over Greenland is a powerful catalyst that could send gold prices to new highs. Investors who are not yet positioned in precious metals need to seriously reconsider their allocation. This is a hedge not just against inflation, but against systemic geopolitical risk. So what's the playbook for the savvy investor? First, increase your exposure to the defense sector, but be selective. Focus on companies with proven technology in maritime, aerospace, and surveillance, particularly those with existing contracts in Europe. Second, be cautious with energy stocks. The volatility can offer opportunities for nimble traders, but long-term investors should be wary of the geopolitical risks. Third, and most importantly, establish or increase your position in precious metals and rare earth mineral stocks. Gold is your insurance policy against the worst-case scenarios this conflict could unleash. Stocks of non-Chinese rare earth miners are a strategic play on the supply chain disruptions this crisis will create. The situation is developing rapidly. We are in the early stages of a paradigm shift. The media narrative hasn't fully caught up to the financial implications of this Greenland standoff, which gives you, the informed investor, a critical window of opportunity. This isn't fear-mongering, it's a sober analysis of a clear and present risk. The fracturing of NATO over Arctic resources is no longer a distant possibility. It's a process that has already begun. The multi-billion-dollar checks being written by Denmark are the proof. Prepare your portfolios accordingly. Don't be caught off guard when this story moves from the financial pages to the front page headlines. Stay vigilant, stay informed, and protect your assets. Thank you for tuning in. This is a story we will be following very closely here, providing you with updates as they happen. Make sure you are subscribed so you don't miss our ongoing analysis. We'll speak again soon. Now, let's talk about why Greenland actually matters, because this is where the financial logic becomes crystal clear. You've probably heard politicians and pundits claim this is about rare earth minerals. They'll throw around big numbers about Greenland's mineral wealth and strategic importance. And they're not wrong, but they're not telling you the whole story either. According to geological surveys and the U.S. Geological Survey's own assessments, Greenland holds between 36 and 42 million metric tons of rare earth oxides. That's the second largest known reserve on the planet, right behind China. At current market valuations, we're looking at $7.6 billion worth of rare earth production annually once extraction reaches full capacity. Not a small number by any measure. But here's what the headlines won't tell you. The experts who actually understand rare earth extraction, the mining engineers, the geologists, the infrastructure specialists, they're saying something very different. Building the infrastructure to extract these minerals from Greenland will cost, in their words, billions upon billions of dollars over decades. We're not talking about drilling a few holes and shipping ore. We're talking about constructing deep water ports in Arctic conditions, building refineries, establishing year-round supply chains through some of the harshest environments on Earth. Think about what that timeline means. If we started today with unlimited funding and perfect conditions, you're looking at 10 to 15 years before meaningful production begins, maybe longer. So if this crisis isn't about getting rich from rare earth mining next quarter, what's it really about? Let me give you the answer that intelligence analysts and military strategists understand but rarely say out loud. This is about denial. It's about making sure China does not get access to Greenland's resources and doesn't establish the kind of foothold in the Arctic that would fundamentally shift the balance of power for the next century. China currently controls 69% of global rare earth production. But here's the number that should worry every American manufacturer, every defense contractor, every tech company. China controls 90% of rare earth processing capacity. That means even if we mine rare earths in California or Australia, we're often shipping them to China for processing before we can use them in our own products. Our fighter jets, our smartphones, our wind turbines, our electric vehicles, they all depend on processed rare earths, and China holds that choke point. Greenland represents a chance to break that monopoly, but more importantly, it represents a chance to prevent China from strengthening it. If Chinese mining companies establish operations in Greenland, if Chinese investment becomes the dominant force in Arctic resource development, we're not just losing access to minerals. We're ceding control of the Arctic shipping lanes that are opening up as ice melts. We're giving up strategic positions along the GI-UK gap. That's Greenland, Iceland, and the United Kingdom, which has been the cornerstone of North Atlantic naval strategy since World War II. So yes, there are minerals worth billions, but the real prize is worth trillions. It's about maintaining the geographic advantages that have protected American interests for 75 years and making sure those advantages don't flip to our primary strategic competitor. Now let's talk about the elephant in the room, the raw military math that makes this entire situation so surreal. Denmark knows they can't stop the United States military. Everyone knows it. The numbers are almost absurd when you line them up. The United States defense budget for 2024 was $895 billion. Denmark's? $723 billion. That's not a typo. Our defense spending is 124 times larger than Denmark's. We spend more on military research and development alone than Denmark spends on their entire military. Aircraft comparison? We operate 13,043 military aircraft across all branches. Denmark operates 117. That's 111 American aircraft for every Danish aircraft. Fighter jets, specifically? We field 190 of them. Denmark has 31. When you run the combat simulations, and believe me, they've been run, American forces could establish air superiority over Greenland in hours, not days. Personnel? The United States has 1.3 million active duty service members. So when Denmark announced that $13.8 billion spending package in January, they weren't calculating that this money gives them a military solution. They know it doesn't. What they're calculating is that this money sends a signal to their own citizens, to other European allies, to the world, that they will not roll over without resistance, no matter how symbolic that resistance might be. And here's the thing, that $13.8 billion is not Denmark's only investment in this standoff. Back in October 2025, they already committed $4.26 billion for Arctic defense capabilities. Add those numbers together, and you get over $18 billion in 6 months. Denmark just spent more than twice their annual defense budget preparing for a scenario where their NATO ally potentially becomes their adversary. Think about that decision from a financial perspective. Denmark is one of the wealthiest nations per capita in the world. They have a sophisticated economy, educated population, and fiscal discipline that most countries envy. These aren't emotional spenders throwing money at problems. When Denmark allocates $18 billion to Arctic defense in half a year, they're making a calculated bet that the risk is real enough to justify that expense. And they're not alone in reading the room. Watch what happened in the markets after these announcements started flowing. European defense stocks didn't just rise, they exploded. The Stocks Europe Aerospace and Defense Index gained 13% in 5 consecutive trading sessions during the first week of January. These are companies like Leonardo, Rheinmetall, BAE Systems, Saab, the backbone of European military manufacturing. They're hitting all-time highs while most investors are still trying to figure out what's happening. But the real tell? Look at precious metals. Gold hit $4,168 per ounce on January 12th, 2026. That's an all-time high, and it came on the same day Denmark's spending announcement was still rippling through international news. Gold gained 1.28% that single day. Not a huge move by percentage, but when gold moves on specific geopolitical news rather than economic data, you need to pay attention. Silver told an even more dramatic story. It surged 4.54% in one session to $83.58 per ounce. Now look at the year-over-year number. Silver is up 181.78%. When was the last time you saw a precious metal post gains like that? When was the last time any asset class delivered triple-digit returns while most investors were calling it a safe haven? The institutional money clearly sees something most retail investors are missing. JP Morgan, one of the largest commodity traders in the world, just revised their gold forecast for Q4 2026. Their new target? $5.95 per ounce. That's not a wild-eyed gold bug prediction. That's JP Morgan, the same institution that historically tends to be conservative on precious metals, saying gold is going to $5,000 within the year. Goldman Sachs published their own forecast, a base case of $4,900 to $5,000 per ounce, with a carefully worded note about risks to the upside. In Wall Street speak, that's not hedging their bets. That's telling sophisticated investors, our official forecast is $5,000, but we think it could go higher, and we don't want to look foolish when it does. What are these institutions seeing that justifies gold at $5,000 when it's already at all-time highs? What's the catalyst they're pricing in but not quite saying out loud? They're pricing in NATO dissolution as a non-zero probability. They're pricing in the fracture of the security architecture that's underpinned global trade, currency stability, and American power projection since 1949. When gold moves like this, when silver posts triple-digit gains, when major investment banks start revising forecasts upward in the middle of an already historic rally, they're not reacting to inflation data or interest rate projections. They're front-running a geopolitical restructuring that most people haven't wrapped their heads around yet. And here's what should really concern you as someone watching your portfolio, your savings, your financial future. These market moves are happening before the crisis actually escalates. We're still in the diplomatic phase. There hasn't been a single shot fired. Denmark is still a NATO ally on paper. The headlines are still calling this a dispute rather than a fracture. But the smart money, the institutional investors who move billions, the analysts who have access to intelligence you and I will never see, they're already repositioning. They're buying gold at record highs. They're piling into European defense stocks. They're treating NATO's internal crisis like it is a bigger threat to global stability than anything we've seen in decades. Because here's the truth they understand. The military disparity between the United States and Denmark doesn't matter if this conflict forces every other European nation to choose sides. The question isn't whether Denmark can defend Greenland. The question is whether defending Denmark tears NATO apart, whether it forces Germany, France, the UK, and other major European powers to decide between treaty obligations and geopolitical reality. And the market is telling you that choice is coming sooner than anyone wants to admit. So let's talk about what happens next, because this story doesn't end with Denmark spending money or gold hitting new highs. What we're watching is the beginning of a three-way geopolitical scramble that will reshape resource markets, defense spending, and currency stability for decades to come. And if you understand the forces at play, you can position yourself ahead of the crowd. Here's the calculation each major power is making right now. The United States needs to break China's stranglehold on rare earth production and processing. Remember those numbers? China controls 69% of production and 90% of processing capacity. That monopoly touches everything from our military's guided missiles to the electric vehicles we're trying to scale up domestically. Greenland's 36 to 42 million metric tons of rare earth oxides represents one of the few deposits large enough to matter on a global scale. Even if extraction takes decades and costs billions, the alternative, remaining dependent on China for critical minerals, is unacceptable to American strategists. But here's where it gets complicated. Europe is reading this situation and reaching a very different conclusion. For 75 years, European nations have outsourced their security to the American military umbrella. They've kept defense spending low. Most NATO members barely hit the 2% of GDP target because they knew American forces would show up if things got serious. That arrangement saved European governments trillions over decades. Money they spent on social programs, infrastructure, universal health care instead of aircraft carriers and fighter jets. Now they're watching America threaten military action against a NATO member over Arctic territory. And European leaders are asking themselves a question they haven't seriously considered since 1949. What if we can't count on American protection anymore? What if the security guarantee we've relied on for 3 generations is no longer reliable? Denmark's response tells you where this is headed. They're not just defending Greenland, they're stress testing what independent European defense actually costs. Denmark traditionally spent around 2% of GDP on defense. Now they're talking about ramping up to 5% of GDP over the next decade. That's not a tweak to their budget, that's a fundamental restructuring of their entire fiscal policy. And if Denmark has to do it, so does every other European nation that can't count on American forces showing up when crisis hits. Think about what that means in aggregate. The European Union's combined GDP is roughly $18 trillion. If European nations increase defense spending from an average of 2% to even 3% of GDP, not the 5%, Denmark is contemplating just 3%. That's an additional $180 billion per year flowing into European defense industries every year for decades. The defense contractors are already seeing this math. The Sachs Europe Aerospace and Defense Index did not just rise 13% in the first week of January 2026. That's the headline. Here's the context. This index has gained 260% since Russia invaded Ukraine in February 2022. It added 57% in 2025 alone. Then it tacked on another 13% in 5 days of trading this month. This isn't a spike that fades. This is sustained structural growth because the entire security model of Europe is being rewritten in real time. Let me give you some specific names that are positioned for this shift. Leonardo, the Italian defense giant, just hit 52-week highs. Rheinmetall, Germany's largest defense manufacturer, is expanding production capacity as Berlin commits to becoming the largest military in Europe. BAE Systems gained 5.5% on January 8th alone, when analysts started calculating what British rearmament looks like if NATO fractures. And here's the value play most investors are missing. Saab, the Swedish defense company, is trading at 2.05 times price to book. Compare that to the sector median of 3.33 times price to book. The market hasn't fully priced in a decade of European defense buildup yet. But there's a third player in this scramble, and it's the one that makes this situation truly unstable. China is watching this crisis and seeing opportunity. If Western investment in Greenland stalls because of this NATO fracture, if Denmark and the United States can't find common ground, guess who's ready to step in with billions in mining infrastructure investment? Chinese state-owned enterprises have been courting Greenland for years. They've offered to build airports, fund mining operations, provide the capital that makes resource extraction economically viable. You see the trap now? The United States is threatening Denmark to prevent Chinese access to Arctic resources. But that threat is pushing Denmark toward the exact scenario America fears most: accepting Chinese investment because Western alternatives fell apart in political chaos. This is how great power competition creates its own disasters. Each side, trying to prevent the worst-case scenario, ends up making it more likely. So what's the timeline here, and what should you be watching as an investor? Mark February 2026 on your calendar. Secretary of State Marco Rubio is scheduled to meet with Danish officials. That meeting is your next major inflection point. If diplomacy finds a path forward, if there's face-saving compromise that lets both sides back away from the brink, you might see precious metals pull back temporarily as crisis premium comes out of the price. But if that meeting goes poorly, if we get more escalation rather than de-escalation, then the forecast numbers from JP Morgan and Goldman Sachs start looking conservative. JP Morgan's $5,055 per ounce target for Q4 2026, that becomes your floor, not your ceiling. Goldman's $4,900 to $5,000 base case with risks to the upside. Those risks materialize fast. MKS PAMP, one of the world's largest precious metals refiners, published a bull case scenario of $5,400 per ounce. In extreme geopolitical disruption, and I think NATO fracture qualifies as extreme, some analysts are starting to whisper about 6,000 gold. Not as a base case, but as a realistic possibility if the alliance actually dissolves or if military conflict erupts between members. Now let's talk about silver, because this is where the math gets really interesting. Silver hit 83.58 on that January surge. The immediate technical target is 88 per ounce. That's the 161.8% Fibonacci extension from the recent consolidation pattern. But the longer-term story is even more compelling. Robert Kiyosaki, author of Rich Dad, Poor Dad, and a longtime silver advocate, has been calling for $200 silver. Most people dismiss that as wild speculation. But look at the fundamentals now. Silver isn't just a monetary metal like gold. It's an industrial metal with applications in solar panels, electric vehicles, and artificial intelligence infrastructure, all the sectors that are supposed to drive growth for the next decade. We're already running supply deficits in silver. Mine production isn't keeping up with industrial demand. Now add monetary demand from investors fleeing geopolitical risk, and you've got the setup for a supply crunch that could send prices vertical. Here's the scenario where Kiyosaki's $200 target stops sounding crazy. NATO fractures, or the U.S. proceeds with Greenland action. Gold breaks $5,000 by Q2 2026. Currency debasement accelerates as central banks respond to crisis. Industrial demand for silver continues rising as AI and solar deployment scales up. And investors finally wake up to silver's dual role as both monetary hedge and industrial necessity. In that scenario, $80 is just your first milestone. $100 becomes the psychological barrier. And $200 becomes the math when you calculate supply deficit against combined industrial and monetary demand. So what's your play here? If you believe NATO's fracture is a real possibility, and Denmark spending $18 billion in 6 months suggests it is, then precious metals are your primary hedge. Not because gold and silver are going to make you rich overnight, but because they're the only assets that historically maintain purchasing power when the geopolitical order breaks down. You're not betting on economic collapse. You're betting on restructuring. Europe has to build independent military capability. That means sustained defense spending for decades, which means inflation pressure, currency debasement, and fiscal stress. The United States has to maintain global power projection without reliable European allies. That means increased defense budgets, more debt issuance, more pressure on the dollar's reserve status. And China gets to watch two of its primary competitors tear each other apart over Arctic territory while positioning itself as an alternative partner for anyone who gets caught in the middle. This is the three-way scramble that defines the next decade of geopolitics. Resource competition, alliance breakdown, and currency instability all happening simultaneously. The institutional investors already understand this. That's why JP Morgan and Goldman Sachs are publishing $5,000 gold forecasts, while gold is already at all-time highs. That's why European defense stocks keep hitting new records, even though valuations look stretched. The smart money isn't trying to time a pullback. They're getting positioned for a structural shift that dwarfs normal market cycles. You don't have to believe NATO actually dissolves to take this seriously. You just have to acknowledge that the probability went from basically zero to measurably non-zero. And when you're talking about the collapse of a 75-year-old military alliance that has been the foundation of Western security, even a 10% or 20% probability justifies real portfolio allocation to hedges. So here's my question for you. When Denmark spends $13.8 billion defending against America, when gold hits all-time highs while Wall Street banks predict it goes higher, when European defense stocks surge 13% in 5 days, what signal is the market sending you? And more importantly, are you listening? Because the choice isn't whether these forces play out. The choice is whether you position yourself ahead of the crowd or wait until everyone else figures it out and prices have already moved. The institutions made their choice. They're already repositioned. The question is, what are you going to do with this information?